Welcome back to Real Estate Mindset. Happy Tuesday morning to you guys. Welcome to the live video for today. I almost did not do this live. In fact, I wasn't going to do this live until I woke up this morning and I saw that the 10-year had sunken back under 4%. I mean, holy smokes, you guys. The market seems to not be able to handle the 10-year being 4%. Absolutely shocking. To me, it's looking more and more like the housing market rally, and really the rally in general, is nothing more than a dead cat bounce. This whole magical economy, recovery, and soft landing is really quite a lie, at least in my opinion. And we're going to go over the data today, you guys. Now, a couple things before I jump into this. Just wanted to let you guys know that I am going to be releasing a video tonight. It's a long video, you guys. It's about 50 minutes. I'm actually teaming up once again with Jack at Nobody Special Finance, and he's going to dig in like hardcore to the job numbers, and we're going to tell you guys like how many full-time jobs were made, how many part-time jobs were made, like who's getting double jobs. And you guys are going to find out that the job market is messed up right now. Despite all of the headlines that we see, we have been losing full-time jobs since April. The only reason why it appears there's job growth right now, y'all, part-time jobs. It's not full-time jobs. The growth is all part-time jobs. So we're going to dig into that and really just kind of try to, bring as many people into the light, into the awareness as possible. Essentially, that the numbers really at the end of the day do not look good. I don't know if Melissa's on, but if you're on, Melissa. So you guys, I reached out to Melissa. I said, email me. I'm going to pay for your test. Melissa's getting her real estate license. So I did talk to her. Want to say a quick good morning. And then we're going to do a total, house market breakdown and a market breakdown. But just wanted to say, first of all, Corporal, sir, good morning. You were first. Love you, dude, from the very beginning. Mary, same to you. Appreciate you. There's my boy, Vital Signs. Vital, I hope you're going to do well this week, brother. Go out, if you can, to those new build communities and tell me how much prices are being dropped. I don't know how far away you are from the Lennar communities in Central California I showed you. But if you can, Vital, get out there, man. Give us some boots on the ground data, and let's see what's like really going on. Because you guys, here's the thing. From this point forward, and this is what I'm trying to tell you, you will start seeing price declines. It might start very slow, and it might take a little bit longer if you're in a tight metro area, but you guys are going to see them. And you probably starting to see the comments where more and more people are like, yep, inventory is going up, and I'm seeing price cuts. And the reason that is, the toxic home buying demand is getting crushed right now. And when the toxic demand is out of the equation and picture, the housing market and the values of houses crumbles apart. There's nothing left to prop it up. But anyways, good morning to you, Vital. Good morning, Sheldon, from the very beginning. Same with you, W2H. I appreciate you. We have Living in Omaha. I definitely encourage all realtors, to join our lives. I'm not going to beat you guys up. I really just want to just work together, share little tips and tricks so we can give them to our customers, right? And then my man right here, the Matty Young, appreciate you. Lamb, appreciate you as well, sir. Appreciate all you guys. Brian, there's my girl TNT, Ricardo, Alan, and Dave. I don't see Melissa, MFH. Nice to see you, man, from the beginning. Cameron, always. I saw you on Nobody Special Financing. Good morning, sir. AJ, I love you, man. I appreciate all your emails. Sam, love you. There's my man, Dave, again. So Broadwick, I'm appreciate you, Steve. Everyone, good morning. There's my man Johnny. I think there's Jeff. What's up, Jeff? You guys, I'm gonna get started. I gotta get started. I'm gonna get yelled at. Beach bum. Oh my God, look at all everyone's here. You guys help keep. Volvo. I love you, Volvo. Thank you. Every single video, this man says, hey, Volvo, I want to get to know you, brother. I appreciate you. I see you every comment. You guys keep me going. Without you, I'm done. Without the community of Real Estate Mindset, I quit. It's your guys' love and your dedication to empowering and learning that keeps me going on my channel, because the reality is, guys, this stuff is hard to sit here in this seat and get criticism from everyone except the people that are listening. Okay, so I just wanted to say thank you. But let's get started now. This is going to be a little bit wild. Here's where I'm going to start with us today. Now, I woke up and I was like, how the heck is the 10-year treasury under 4%? It just was what, 4.18 or something? You guys, look at the VIX. Okay, so I'm going to start this with the VIX right here. This is the VIX. This is the volatility index. Y'all, this is up 11%. So what this is telling us right here, whenever the VIX, the VIX shoots up like this, something is going on that is bad, right? Something's going on that's bad. And a lot of times, obviously, the 10-year, it has a mind of its own sometimes. It can go up with bad news or down with bad news. Now, the 10-year plummeted this morning on the bad news. And we can see that it's truly something bad because it's corresponding with this VIX, this volatility index right here. So it's a big deal. Let me show you guys the 10-year. Okay, so it's rebounded a little bit. When I woke up, you guys, the 10-year was down like 11 basis points. This isn't normal. This is not normal. The fluctuation in the 10-year, there's a lot of scared money. There's a lot of flight to safety. There's a lot of stuff going on in the background, be it in the world or, where we're at here in the United States. The 10-year is all over the place. And and we've been covering this pretty much the entire time we've been in this quantitative tightening. That 10-year cannot stay at 4% very long. In fact, when it was in the 4%, remember what happened? The bank runs. And then it went back under 4%. So it's crazy. And the thing is, let me ask you, Vital, all right? Let me ask you guys. If the economy was strong, okay, well, let me rephrase it this way. Do you guys think the economy is strong because it is, because the interest rate stays under 4%? I mean, what indication do you guys see that as? What do you think the condition of the economy is if the 10-year cannot stay 4%? Does that mean we have a strong economy, or does that mean we have a fragile, weak economy? To me, when I see this, when I see the inability to stay in that 4% 10-year, to me, it's a clear sign the economy is a joke. It's propped up on debt and free money and low interest rates. So when you remove that, it falls apart. And why hasn't it fallen apart for the continuation of this year? The quantitative easing back in March. You guys, we can literally pinpoint, going back in time, we can pinpoint all of these details. So we really don't have to guess what's happening. Now, obviously, one of the things that is crazy is the toxic home buying demand sentiment and the fear of missing out. That's pretty crazy. But take a look at this, guys. Let's go back here. So the question is like, okay, what's going on with the 10-year, right? The entire market is collapsing. Look at this, guys. Everything is down, including gold right now. So like, what's going on? Why did the 10-year drop? And really, I'm just going to summarize that into China. Okay, U.S. stock futures slip after weak China data dampens sentiment. So basically what's going on, I almost said president. I almost said what's going on with our president. Geez, you guys, I mean China, not our president. What am I talking? I'm so sorry. So listen to this. What's driving markets? A risk-off tone was enveloping global markets and suppressing U.S. equity index futures after weak China trade data heightened concerns about a slowing global economy. And what I'm trying to tell you guys is the cat has been out of the bag. First of all, the cat has already been out of the bag, but they jammed that cat back in the bag and really blinded so many people. So much of society does not know what's going on. I mean, I swear, guys, it's crazy. I get some comments still, and I talk to people, and they're like, dude, the job market's on fire, unemployment's low, the economy is good, home prices are going up, you're crazy. And I'm just like, based on what? What's great about the economy right now? The money printing? The free money that it needs to stay propped up? Is that what's good? I mean, they're talking about the Fed put. Anyways, I mean, look at this. China exports fell. Okay, so exports fell 14.5% for the year to July. Okay, so China is in much rougher shape than the world thought. And that's actually normal with China. They always lie about their data, in my opinion. Everything that comes out of China's mouth is a lie, especially when it comes to finance, especially when it comes to stocks. I mean, look at LP, or what was that, Lincoln Coffee? Y'all remember the Lincoln Coffee debacle? Complete lies. But anyways, that's the biggest decline since the outbreak of COVID-19 pandemic back in February 2020, while imports slid 12.4%, worst than forecast. Okay, the news highlighted the world's second biggest economy is being dragged lower by weakness in global demand and domestic slowdown. So personally, y'all, when I read something like that, to me, what it's saying is global recession. Would you guys agree with that? I mean, I mean, come on, guys. I mean, are we still in the like everything's okay camp? Like, I get that home values rebounded for less than 5 months this year, and everyone wants, oh, you're wrong. But the reality is we're not. Sometimes these crash cycles, it's a cycle. It happens like this. And all we're really saying is, people on my side of the coin is what we're saying is basically be cautious. There's a lot of people lying. There's a lot of financial biasness out there, and houses right now are extremely overvalued and extremely unaffordable, and we're in one of those times where extreme caution is needed. Now look at the interest rates, you guys. Okay, I'm going to tell you guys there's something crazy going on right now. I am going to pull up a chart and I'm going to show you Black Knight, but generally the 10-year and the 30-year fixed rate mortgages really coincide. Whose birthday is it? I'm a day is your birthday? Oh my God, Alma Day. Happy birthday, Alma Day. I just saw that, you guys. I'm sorry to get off track to anyone that's coming back to watch this, but I love Alma Day. She supports us. She's a big part of the real estate community. Happy birthday, girl. Appreciate you. Definitely appreciate you. Sorry about that, guys. But anyways, here's where we're at with interest rates, 30-year fixed rates at 7.06. Crazy thing is I don't know if you guys noticed this, and I'll show you a chart here in a minute. But there were a couple occasions where, I'm sorry, my focus, the 10-year actually dropped. So the 10-year went lower, but residential mortgage rates went higher. Interesting if you think about it. It's probably a result of bankers not wanting to give up their money. Now, what I'm going to do, guys, that's our housing market update. I'm going to quickly before I go into the videos, okay, I want to briefly I'm going to put a timestamp, but I want to briefly go back into credit reports. You guys know that I really want to give you guys a lot of value. A lot of value is going to be more so in my live videos, and kind of my housing market update will be in my live videos. And the problem with just doing pure education videos is, and this is so crazy and really unfortunate, I kind of get penalized. Like I literally, if I don't get a certain amount of views on YouTube, the algorithm penalizes my channel. So it's really depressing, because to be honest with you guys, all I want to do is like talk about like loan structures, credit structures, income, all of these great tools. But I have to play the YouTube game. So I try to slide in value. I try to slide in value on every one of my videos, and that's what I'm doing now. And I really want to pay attention to collections right now. There's a lot of preconceived notions with collections on credit reports. And we're looking here at a credit report under the derogatory section. Again, I'm going to nip this in the butt because this is really, really valuable. Now, first of all, what I want to say is this. I have people that ask me, Travis, should I pay off my collections? And generally, you have to understand, I'm talking generally here, okay? Now, when someone asks me, Travis, should I pay my collections off on my credit report, and will that help me? Generally, like 99% of the time, my answer is no. Do not pay off your collections unless it's to avoid a lawsuit, or you need it for licensing requirements like I needed. In order to get my real estate license, I had to pay off all my collections. And remember, I had a bankruptcy, repo, and collection. Bankruptcy, repo, and foreclosure. So I had a lot of stuff to like handle to get my license. So anyways, the point that I make is with these collections, the damage is already done. They've already hurt your credit, and by paying it off, it doesn't help you. In fact, listen to me, sometimes by paying off collections, it can hurt your credit. The reason that is there are times on the derogatory sections, and I'll show you here, where there's a date last reported. So under derogatory trade lines, there's a date last reported. So if it's not had any activity for 2 years, you go in and pay it, and then it updates the account and it shows recent activity, it can hurt you. So you don't want to pay off your collections. All right. I'm just going to say, but here's the thing. When it comes to loans, okay, collections will count against your debt to income ratio depending on the loan. Like conventional has their own rules, FHA has their own rules. So talking about FHA, generally, if your cumulative total of collections exceeds $2,000, you have to take all of the collections that you have. Like if you have $10,000 worth of collections, and you have to assign a 1% or 2% payment on that. So if you have $10,000 in collections, 1% of that is $100. I think it's 1%. It might be 3%. I have to double check with the underwriter. But my point is yes, collections can hurt you, but just paying them off alone will not help your credit. And I wanted to make that clear. But let's go back into this. So this is the collection. And here's the interesting thing. When I pulled this credit report up yesterday, you guys saw how many late payments there were. These people were struggling in debt. And I had someone comment like, Travis, this isn't normal. You're cherry picking the data. This isn't a true reflection of society. And the reality, and I thought about that. And I'm like, man, like the sad reality is this is absolutely what most people that come to me that look for a house, most people are in this situation. We got to go through 10 to 15 credit reports and applications, guys, to get one person qualified. Almost everyone is in a similar situation to this. I'm sorry to report. It's a horrible, horrible thing. And that's why Dave Ramsey makes so much money. These people are so desperate for help. But anyways, going back to this collection. So I'm going to review this as a loan officer. So as a loan officer, the first account I see in collection is education, okay? Education credit management with Bank of America. So I'm thinking two things already. The first thing I'm thinking is, oh my gosh, I hope this is not a school loan, because if people are in default or if their school loans are in collection, you can't get a government loan, okay? If your school loan is in collection, you cannot get FHA, VA, USDA, all right? Because you owe the government. Now, when I see this first collection, it looks like a private school loan. If it's a private school loan, who cares, right? But those government ones like the Sallie Mae, you guys have to have those caught up, because if I'm a loan officer, I see this in collection, I have to pull something called CAVERS. Okay, every loan has to be, a CAVERS has to be pulled. Now, the problem with that is generally a CAVERS, which is making sure you don't owe money to the government. The problem with CAVERS reporting is generally that's done at the very end of the loan transaction, okay? And if there's one thing that I've learned about being a loan officer is you don't want to wait to the very end of the loan transaction to do your due diligence. So as a loan officer, I see this, and even though it says private, I'm running a CAVERS. If I run that CAVERS and this person comes back as they owe the government money, they can no longer get an FHA, VA, or USDA loan until they clear that up, and it's a very difficult process. Now, the next thing that I see here. So anyways, anything educational under collection, huge problem. And you guys see how the first collection, look at it's over the $2,000. So that first collection has a balance of 15 grand. So I got to make a 1% or 3% payment depending on the loan. So this first collection, even though they're not paying it, it hits them on their debt to income ratio. I have to come up with a $150 payment. Do y'all understand? Because that's the rule for loans. Collections have a payment when it comes to qualifying for a loan. Do y'all understand? Now look at the second collection. Look at this tiny little baby collection, $684 collection, destroyed their credit, harmed their credit beyond comprehension for $684. Now, okay, the next one is 609. And look at this little $78 collections ruining their credit. So if this is me and I have to pay these off, right? So I had to get my real estate license. I had collections. I had to pay the collections off. Now, what I did, if this was my credit report, the way that I pay collections off is I call them up and I settle for pennies on the dollar. I say, I'm willing to pay you, but I'm only going to pay you 50 cents on the dollar. And also there's a magic trick. There's a magic trick. I had about 5 collections. I think it was either 2 or 3 of the collections. This is what I said. I was like, I called the collection company up. I was like, y'all, this is not mine. It was probably mine, but I was like, it was not mine. I don't have time to fight you. So I'm willing to pay this off, but I need you to send me in a letter of deletion. So in other words, I said, I'll pay it, but you have to remove it from my credit report and basically say it was reported in error. Did y'all know you can do that? That is a little trick. It's not supposed to, that's like, it's not supposed to happen, right? Like there's such a problem with credit right now. It's like the Wild Wild West. They're getting away with so much crap. So anyways, if you guys get a deletion letter, that will significantly help your credit because it will remove the collection from your entire report. And one last thing, you guys, generally these collections will last 7 years unless they sell it to another collection company. And then the clock starts all over again. Can you believe that? And then here's where it shows bankruptcy. So bankruptcies would be listed right here as well. Okay, bankruptcies can hurt you also for 7 years. It really depends. But anyways, I hope you guys like that. That was just our brief credit report. I'm going to try to throw in like little valuable things like that each of these videos because I really appreciate you guys. So we're going to listen to our first video. And this first video is interesting. This is going to be Black Knight. And Black Knight has been incredibly bullish. We just heard a video from Black Knight yesterday talking about, oh, home values are going up. Everything's okay. So now we're going to listen to a video from overly optimistic Black Knight talking about how unaffordability is at a 38-year high. So the same person that said home values are going to keep going up is also saying it has not been this unaffordable for almost 4 decades. So that's going to be our first video. If you guys can, let me know if the audio is good. And then after this video, you guys, we're going to go into Black Knight and I'm going to show you the report. Really, really interesting stuff. And again, if you can let me know the audio is good, really love you guys. Thank you for sticking with me.
It feels to me like markets are markets. And if rents are that much cheaper than homes, then people will flood into the rental market at some point. But maybe they won't, because a lot of the millennial cohort was just looking for the lifestyle change of, house in the suburbs and yard and all of that.
Yeah, and I think part of it is there's no good options right now. You mentioned it earlier. Home affordability as of this morning is at a 38-year low, lowest since the mid 1980s. And rent's not affordable either. I mean, rent prices tend to trail home prices. They're slowing down a little bit, but you're still seeing unaffordable rents out there in the market as well. And so regardless of where you look, shelter costs are just simply expensive.
Yeah, they are expensive now, but if you kind of look a year from now, it's pretty clear that while home prices might still be even higher, rents seem like they're going to be a better deal.
Yeah, when you look at rental growth, it tends to trail home price growth out there in the market. And so what you're seeing out there in terms of rent prices is exactly what we've seen in the housing market over the last 18 months. We've seen that home price growth rate go from 20% down to effectively zero in May. You're seeing rents follow that same path. But what's interesting in June is that you've seen an inflection in the housing market and start to heat back up. And that's kind of our expectation as you look over the next few months. We're at 0% last month. We expect 2% home price growth by next month, maybe 3% by the following month. And so you're going to see that kind of reaccelerate as we move into the fall.
You think up 3% year on year?
Yeah.
Wow. Yep. So what was we talked last time and it was interesting how you said, in 2022, we saw a big reset in some markets like San Diego, but not all markets. And so where are we now nationwide? Where are these price hikes coming from? And are they kind of coming from everywhere at this point?
It's a little bit of everywhere. It's not proportionate everywhere, but 60% of markets are up. And when you look at kind of where it's taking place, if you just look at June month on month, seasonally adjusted, the strongest gains are in the Northeast and Midwest, right? Those are markets that had been strong. They've got low inventory and relative affordability. So those are the markets that had been hot and had stayed healthy. But what's interesting about June is the western part of the U.S., right? So your San Jose's and Seattle's that had seen some of the largest price drops have turned a corner and are number 2 and number 3 in terms of price gains in June. And so you're seeing some of those West Coast markets, some of those pandemic boom markets, with the exception of Austin, starting to pick up a little steam this year as well.
Wow. And why do you think that is? As we hear these headlines, even today, Zoom calling people back to work and company after company, what's keeping those one-time pandemic hot markets still hot in the housing space?
Inventory is a simple answer, right? It's all a matter of inventory. The reason that Austin is still cool is Austin is the only market that's back at or remains at quote unquote normal levels of inventory out there in the market. Some of those West Coast and pandemic boom markets that had moved back into balance and moved to pre-pandemic supply levels have done an about face, and their inventory has fallen again this spring as sellers haven't sold. And so as that inventory has fallen, you've seen those housing markets start to heat back up.
Yeah, and it's not until the 10-year drops significantly that we should expect a change in that, right?
Yeah, and even when that 10-year drops and folks come back into the market, you're going to see demand return along with that. And I'm more confident in the demand returning than I am at the supply, right? There are some signs and signals that folks are saying, hey, we'll sell when we get to 5% interest rates. I'll believe it when I see it, right? And we've seen it take place on the demand side. We haven't seen it take place on the supply side yet. So there's still some uncertainty about when that supply comes back.
Incredible the way that rate hikes have driven inflation in the housing market and maybe now to some extent in the oil market as well. It's maybe people would say it's textbook, but it's not what I was expecting. Andy, thanks for your time today. We appreciate it.
You bet. You bet. Thank you.
All righty. So that is our first video. And let me know that if you guys liked it. I'm going to show you guys the Black Knight report real quick. This is really eye-opening right here, you guys. So here's the report. It's a little bit hard to see, And so on one hand, he's talking about all these things, and I just, I don't understand why people aren't really paying attention to this. This is really, really important data here. Hopefully you guys can see this okay. This is the national payment to income ratio. One of the reasons, y'all, I think this is okay, that I think this is important, and I'm more than willing to specifically explain why I believe what I believe, and provide data to support it. So one of the things that I've been essentially saying for right now that is leading price crashes, for right now, when I've done my research in Texas, is the equity run up and the unaffordability. Those were the two things that I saw that the top crashing metro areas were leading in, both equity run up for that area and unaffordability. And when we look at the national unaffordability, you guys can see just how bad the problem is on average. There are some northern states that have really low national payment to income ratio that are sustaining much better through this resetting and crashing housing market. But I do want to point out that this did update, and it's now at 36.4%. And please, you guys, this really is pertaining to anyone that's buying right now and really pertaining to anyone that purchased after 2022. We understand that people that were purchasing prior to 2022 generally have really low interest rates and a ton of equity. In fact, I will argue that some of the best buying opportunities may have been during 2019 to 2020 because of the low interest rates and equity didn't run up. So what we're talking about is right now. We're talking about what's going on right now. And the fact that 36.4% of average median income, household income, goes to only, principal and interest is it's just outrageous. We want to be sitting at 25%, which is kind of where you see, we've been under 25%. You guys see that blue line? We've been under 25% for what, a decade? That's where we need to sit. We're way high right now. So when we add the taxes and when we add the insurance, it gets way worse. But let me scroll down here, you guys. I didn't have a huge chance to look at this in like extreme detail, but I did want to point out a few things here because this came out this morning right before the live. Now, what we have here is the month over month change in HPI, which is basically HPI is like Black Knight's Zestimate, right? Like, how Zillow has a way to tell us how much value of a house is. This is Black Knight. Black Knight has their own thing. CoreLogic has their own thing, right? Different companies have their own stuff. This is Black Knight's. It's called HPI. Now, this is month over month. And I want to point out, remember last month, it could have been the month before. Every single metro area last month was an increase. I believe also even Austin. Now, the reason I'm pointing this out is this isn't normal. These types of seasonality swings and median sales price is normal, but value decline is not normal. And what we can see here is even during the peak home buying season in 2023, these metros could not rebound during one of the hottest months of the year. Do y'all see that? Specifically, I'm talking about Austin, and it looks like that's San Antonio right there. But a lot of rebounding. Y'all see that? So a lot of places did rebound. And I believe that rebound is basically a lot of people thought they missed out on opportunity. Like, oh my gosh, the housing market's not crashing. So some of the people that were on the sidelines waiting for like rates and stuff were like, oh, I lost my chance. Let me run back into the market and let's buy. Hey guys, I'm pretty sure it was based on fear of missing out. And I'm basing my opinion on the 93% buyer's remorse survey, right? 93%. Buyer's remorse survey. But this is very good as well. Now, this is going to paint us a picture of, did home values rebound enough to basically, gain what they lost? And the answer to that question is absolutely not. So even during this, all these headlines we see, oh, the housing market's not going to crash. The housing market's rebounding. Okay, look at this map. Okay, this is showing us all of the places, this is what I'm going to say, all of these places that are showing negative are going to get even worse this year because we're out now of that hot spring and sun buying seasonality. We are done with that. So these gains you guys see here are going to go down, and the places that already have declined is going to get worse. And again, what's very interesting, you guys, pay attention to what I'm saying here. What's very interesting about this map is if you put an overlay on this map and you look at some of the most unaffordable places in the US, you can see that the unaffordability almost matches identically the price decline. The outlier is the East Coast. So the outlier is basically all of this little area right here. So that little area right there was an outlier, a little bit in Florida, but you can see Florida's changing. Look, we already have a decline in Florida from peak, 2%, 1.4% right there. That looks like Jacksonville. Maybe that's, I don't know, Cape Coral. I don't know, Cape Coral, I'm sorry. But anyways, you guys, pay attention to this because it's done. It's in the rearview mirror, and now things are going to start falling apart once again. We already see it. We've had 4 weeks straight of median sales price decline, which I know it's not a value, but it is an indicator. Pay attention to what I'm saying because it's going to get bad. And in your metro area, again, what I'm saying, you will see price declines. It may happen slowly, but most everyone is going to see that. Now, take a look at the leaders here. This is interesting, and you can see how they have a different valuation system because look at the top metro areas of decline. So we have basically Redfin saying Austin's down 9%. Black Knight saying that Austin right now, as of June, is down 13.6%. You guys, come on. How is that not like a red flag, right? 13.6%. I mean, what about all the people that purchase? How do you think they feel? And then when we add the 8% it takes to sell your house, how much are they really upside down? 20%. Think about it. Think about what I'm saying. People are just sold on this fear of missing out. All right. If you're buying real estate, which is generally a great thing, use the data, use your goals. You know what I'm saying? Don't use your emotion. Number 2 city, San Francisco, 8.8. Phoenix, 8.4. There's a lot of realtors of Phoenix that are still saying Phoenix is hot. Just buy right now so you can trap yourself in like all these other people and lose equity. I understand that existing homes in Phoenix right now, the inventory is super low. But what realtors don't understand in Phoenix, not all, but some, not all, okay? What they don't understand is the unaffordability is out of control and the equity run-up was completely breaking all fundamentals. I don't think they understand that. They just want to, oh, there's not that much inventory. Come to Phoenix and buy. It's still a great time. But yeah, 8.4% down. Las Vegas down 7.8. Seattle still down. Again, in the peak, but they couldn't rebound. So it's going to keep going down now. It's going to keep going down. They couldn't recover. None of these places could recover. San Jose 6.8. You guys, it may take years. It may take 3-4 years for that peak to be hit. It may take 5. Who knows? 3 years, 2. Who knows? But it's going to take years, more than likely, to get back to the peak. It didn't happen this year. Overall, it didn't happen this year. Again, depending on the value calculator, and I'm really watching Case-Shiller. Case-Shiller is such a lagging indicator, but I'll be watching Case-Shiller on that. But as far as median sales price, it did not reach the peak. It's going down already. Sacramento at 5.6. Salt Lake City, I want to get out there. My son's out there. I'm sorry. My son's out in Boise. My niece is out in Salt Lake City. Also, Denver down 4.3. Nashville 3.5. Dallas 3.4. We got Portland as well. Down. I'm sorry, you guys have to like lean around the camera. And then Raleigh, Portland, San Antonio. And now look at California. So we have 2 California metro areas on here. We have Riverside and we have San Diego. We have Riverside down from peak 2.5%. Okay. We have San Diego down from peak at 2.2%. We have them down from peak during the most hot time to buy real estate in the entire 2023. So I want to point out that Riverside, and especially San Diego, you guys can find this out for yourself. They have let's talk about San Diego, like no existing inventory. San Diego has such a horrible, shocking, like existing home inventory problem. It's like mind blowing. So if they have a horrible, horrible inventory shortage, and yet they're down 2.2%, right? Probably top 15 metro areas of decline. Why is that? Because the laws of supply and demand say that since the supply is going down, the prices are going to keep going up, but they went down. Why? Why did it break the laws of supply and demand, y'all? Why? It goes back to those 2 things I said. 2 things, equity run up and unaffordability. The bigger the equity run up and the more unaffordable it gets, the more likely and probable it's going to go down. We see it in San Diego. San Diego has no inventory at all. I don't even know if they hit 2 months of inventory this year. I don't know. I'll check. But anyways, thought you guys thought, hopefully you thought that was interesting. Okay, this is just year over year. So here's a year over year map right here. This is basically showing you guys, all right, again, year over year, Okay, we're just looking at year over year, and this is June. This is where it's basically peaked. Look at that. Look at all the cities that didn't rebound. And guess what? I'm trying to tell you again. Now, all of these cities in blue you guys see here, they're going to go down from this point forward. Actually, from about 4 weeks ago, overall. All right. They couldn't rebound. So again, I say to the bulls, the housing market's great. Okay. There was no crash. It's canceled. Y'all, what about all these metro areas? What about all these states that couldn't rebound? Massive declines year over year still. Massive. Now, I know it's year over year, and we want to know what's going on right now, so I'll move on. But I thought that was interesting. And here's the leaders right here. Hartford, Milwaukee, Philadelphia, Cincinnati, Virginia Beach, Kansas City, Providence, Baltimore, Richland, and St. Louis. So, I don't know. Hope you guys thought that was interesting. I love the data, and I hope you do too. We're going to go into our next video right now, you guys. This is basically the market. This one's going to be on the market. The market, after this video, we're going to take a look at the market. We're going to see if the market was pricing in we're going to see what the market thinks the Fed's going to do. Is the market still fighting the Fed? Are they not fighting the Fed? What's going on? And then remember, guys, at the end of this, I'm going to bring up just a couple comments to have a brief discussion. Very interesting video. Let me know that the audio is okay. Really appreciate you guys hanging in there.
Rate cuts at this point, but you know about real rates and how restrictive we're getting up to 2009 levels here.
Well, I certainly don't think they're going to be cutting this year. I actually think they're more likely to increase this year. And the president is correct when he says that if inflation comes down next year, the Fed will cut. I'm not as optimistic as he is about inflation coming down, but obviously, if it does, they will cut rates.
So you do think, okay, so what are we talking about inflation coming down to? We're about to get the CPI report later this week. And Williams, I mean, if we kind of back up from what he's talking about and say the Fed funds rate is now, I'm just going to round up 5.5, then the inflation rate has to be below 3.5 at least. You think that's where we're going to be this time next year?
I think the answer is we will see. The most important thing that's happening in the economy is the solid wage increases. They are going to continue. Earlier story mentioned that they're probably going to become more widespread. We now have sort of a standard 5% or higher contract settlement. Usually that's front loaded, which means you're going to have more cost pressures in the short run. The other thing I think that's important is that no matter what the Fed does, the long end of the curve is going to continue to rise in rates. By the end of 2024, I would imagine the inversion will be over, maybe well before then. And we're going to see the longer rates up in the 5% area. And that means that money is going to be hard to come by. All money is going to get more expensive. And it's the government deficit that will drive that.
Wow. And that's obviously the Bill Ackman argument, Steve, that, he thinks the 30 years going to 5.5%. So there's this split between people who think rates are, and that part are going to stay, much higher for longer, kind of normalized like they did a couple decades ago. And those who think we could go back to something more like the 2010s.
Yeah. I mean, there's an idea out there that the Fed will be not going back to zero. I think there are people who would applaud the Fed not going back to zero. And I think there's an idea that the curve is going to uninvert. What is the right way? Revert? What is? Somebody give me the verb there. You can write in on Twitter. I'll check it out.
It's going to flatten. How about that?
De-uninvert, flatten, or actually go back. The long end will rise in any event. But I just want to be clear about what Williams is saying, because the Fed looks at things in a different way. And I think Larry knows that. They look at real rates. What if I told you that the Fed plans to cut its nominal rate, but there's a way to measure it that shows real rates actually increase? What I'm showing you there now is if you base that on their projection for PCE next year versus their projection for their nominal rate this year and next year, it goes down by 0.3 while they cut 100 basis points. Now notice 2.4% real this year, 2.1 next year, And that is relative to what they believe the long run rate should be,
So they think
0.5.
this is the real question. People think, well, what is the kind of normal real interest rate?
Right.
And they think it should only be 0.5%.
A half a point above
the inflation
rate. So
wow.
just to be clear there,
we're way above that right now.
They are restrictive in their mind. Okay, now Larry may have a thought on the right deflator to use there, whatever it should be. But let me just point out that if you use their headline PCE number, they actually get, core PCE number, they actually get more restrictive next year relative to their core PCE for this year. So
even if they stop tightening,
the markets, it's one of those things that I always wonder. You can fool some of the people some of the time, in the sense that let's all buy stocks because the Fed is cutting. In the Fed's mind, it is not really getting that much less restrictive.
Larry?
I think that's right. I think that's one of the reasons they probably won't cut. And if the labor market continues the way it will, or the way it is, then I think that, in fact, those inflation numbers are likely to go up.
So in other words, Larry, you would take cuts off the table, not philosophically, but just practically. You just don't think the inflation rate's coming down that much next year.
That's correct. And I think we're going to see actually a little more upward pressure. We've already seen the turn in commodity prices and oil. That's a small part of the total inflation, but it works its way through the system. And again, it's labor. And there is no real softness as far as wage negotiations go. One of the things about the unemployment report, the employment report that isn't getting a lot of mention, is that we are now up above where we were in 2019 in terms of participation by prime age individuals, 25 to 55. Not that there's anything wrong with people my age, but that's where the growth in effective labor supply has to be. And we're already fully employed there.
Okay. All right. So let me know what you guys think. Who did you agree with? I mean, I like personally what he was saying. I don't know if you guys caught it. He basically, it appeared that he implied that the 10-year, or long-term rates would hit 5%. They can't even stay at 4% right now, but he's saying 5%. He's saying that he anticipates inflation will still be bad in 2024. He anticipates that the first, signs of rate cuts will be at the end of 2024. He hit some really good nails on the head. Like it's kind of like a double-edged sword what's going on right now. On one hand, the job market is not, as far as like good jobs, is not strong. Okay, there has been a decrease just from month over month. We've lost over 250,000 month over month. We've lost over 250,000 full-time jobs. The growth that you see is part-time jobs. However, one of the issues is crazy is people are asking for more money. People are asking for raises, and they're getting it. So the Fed doesn't want that, right? The Fed's going to have an issue with the wage price spiral, all right? So that went up, even though a lot of other things didn't go up. But also what went up is participation. So there's a lot less people on the sidelines. Why do you think that is? Probably because they need to work, right? So let's see now what the market is anticipating that the Fed does, all right? This is CME Fed Watch. We know that the market gets it wrong a lot, and this changes a lot. And usually, and we have a lot of important stuff coming out this week. This is going to flip this week because of what we have, CPI and PPI coming out this week. So this is all going to change. But I could tell you right now, the market is saying no rate hike in September. Right now, they're basically writing it completely off. The market's saying, nope, look, there's a squirrel over there. Who cares? It's not going up in September. You guys can see only 12.5% chance, or 12.5% of the market is saying quarter bip hike. Now look at November. November's worse than last time. November went down. So they're not even pricing in the second rate hike in November. They're only saying 26.9%. December, even less chance, only 24% chance. So at best, they're saying 0.25% chance at best. So they're not listening. The market, according to this, is not following the direction of the Fed. Maybe that's part of the reason why things are so confusing. Maybe, right? Let me show you guys this. Now, let's look at rate cuts. So the market is saying that there is a higher likelihood of a rate cut in January of 0.25 basis point that, listen to me, the market is saying there is a higher likelihood of a quarter rate cut in January than a second rate hike. Do y'all see how the market is playing the Fed right now and completely like, we're just going to do whatever. I mean, it's crazy. Look at that. They're saying 32% chance right here of a rate cut. Insane. Look at March. March is 41. Look at 41 in March. Let's see what May looks like. 20. Oh my gosh. Look at this. This is new. This updated. So something happened, which doesn't make sense because I'll show you the 5-year break even right now. But look at, they're saying, the market's saying in May, a second rate cut in May. So they're saying first rate cut, basically January, second rate cut May. Do y'all see this? That's what so I don't know who you want to listen to. You want to listen to the market. You want to listen to this money. That's what they're saying. Other people are saying other things. Let's look at what June is looking like. Interesting. I mean, it doesn't really give us much in June. So really, from now until May, the market is really kind of doubling down here. Really interesting to see this information. Really interesting to see. Anyways, we're going to get into our last video. And then after our last video, I'm going to give you guys a quick rundown of the inversion of the 10-year and the 2-year. I'll do the 5-year break even, and then we'll take a look at consumer credit card debt. But let me timestamp video real quick, and we're going to get started. And this one is additional rate hikes likely needed to moderate inflation. So again, we're going to listen to another person that says we need more rate hikes when we just got done reviewing the market saying no more rate hikes. Who do we listen to? Who do we listen to? I understand why people are confused. My gosh, who do we listen to? Let me know the audio is okay.
The man who does that work for us is Steve Leisman, and he joins us now to try and tell us exactly what's going on here. Steve.
Yeah, good morning, David. Fed Governor Michelle Bowman speaking this morning, saying she expects additional increases, saying they're likely needed to lower inflation. She says monetary policy is not a preset course, though. She is going to monitor data. But here's her test for saying if we've got enough. She says looking for evidence inflation is, quote, on a consistent and meaningful downward path. She added that the labor market remains tight with demand for workers outstripping supply. Her comments were also made, by the way, by New York Fed President John Williams, released this morning, and echoing concerns that, hey, that Friday jobs report may not have been as hawkish, or may have been more hawkish than the market first thought. Among the concerns inside that report, job growth has been consistently greater than population growth, and that's reflected, by the way, in the still strong wage gains that are out there. The unemployment rate ticked down, and even slowing payroll growth is seen by some as a result of there being not enough bodies to hire rather than an unwillingness to hire. Chris Rupke writing, this could be the first time in economic history that payroll employment drops, which normally indicates a recession, but the reason will be there's no one in the country left to hire. The problem could be revised away in January. The government will re-estimate population growth. You can see in that chart there, the last 2 years, the problem was solved with the addition of 1 million people in each of the past 2 Januaries when they do that exercise. Government's also going to revise job growth, likely down. That number comes out in August. For now, Fed officials have to puzzle with this problem that there are more jobs than there appear to be people, and that's going to keep further rate hikes potentially on the table for some officials, guys.
Okay.
The way you see the world depends on how you
how
look
the
at
audio
it.
was good because I
While
accidentally
some-
hit the wrong button. I don't know what to tell you guys. I mean, this is just so crazy. I'm trying as best as I can, but I mean, look at, they're bailing out the banks. Let me show you guys this real quick. Let's go into CoreLogic. CoreLogic is another, like Black Knight, CoreLogic has their own forecasting, and theirs is called HPI forecast. So again, Black Knight has their own value system. CoreLogic has their own value system. So I wanted to go into a recent forecasting model from CoreLogic. And again, I think this is incredibly bullish. They don't really go into the concerns that are like, in my opinion, really valid concerns like equity run up and unaffordability. But anyways, here's what they're saying. Basically, they're saying that they're forecasting homes to go up 4.3%. All right. And they're going to go up 6% from June, July. That may be. But what I wanted to basically point out is they've been forecasting 4.3%, but it actually is 1.6%. And guess what, guys? We're now going into a declining part of the cycle. I already see it. Maybe it will start slightly slower than last year, but it is how it has already started. So the fact that they're saying 4.3% year over year, I mean, I think it's reckless. Let me know what you guys think, but they're still being incredibly bullish about home price growth. Again, we're past the buying season, the hot buying season. We're past it. In fact, as soon as kids go back to school, it's going to be completely dead. You guys will see. But I also want to show you this. All right. So here's the market, some of the markets that they're tracking. So they're saying that there's going to be home price growth, even though there are still markets, according to their own valuation system, that have negative valuation. So I wanted to point that out because, again, to me, if you're going to do an accurate forecast, and I do the best that I can, I'm not one of these giant companies. If you're going to do an accurate forecast, you have to take into account the red flags. You have to take into account that part of the country is breaking. Yes, a lot of it is not, but part of it is breaking. And you have to take that into account. And you have to ask yourself, why? Why are home values down in Phoenix? Why are home values down in San Diego? San Diego doesn't have inventory. Why are home values down there? You have to ask yourself why, right? That's just, just my opinion. Now look at this. This is interesting. This is CoreLogic's top 5 metro areas that are the highest likelihood to see price decline. When I read this list, I was like, what? This is crazy. So Florida is softening up. Florida is definitely softening up. Look at number 1 on this list. Number 1 most likely metro area, according to CoreLogic, to experience decline is Cape Coral and Fort Myers, Florida. Very intriguing. Number 2, another Florida metro with Northport, Sarasota. Interesting. Look at 4 is Provo. 3 is Provo. 4 is Spokane Valley, and then 5 is Lakeland, Winter Haven. So what do we see here? We see 3 of the 5 of these metro areas, Florida. Do you guys remember me saying at the beginning of this year, Florida made it out of 2022 real well as far as not having price decline. But when we started this year, Florida showed like immediate signs of softening. So now we're starting to see that. We're starting to see some metros. I think Jacksonville was one of them that is on the year-over-year price decline list. But we're now starting to see those metro areas catch up. Now, let me show you guys the 2 and the 10 real quick, okay? And we're almost done here. This is really interesting. This is really interesting because over the past few days, this has been like trending to uninversion. But the 10 and the 2 year is our economic sign. This is our, the main president that we have to remain cautious. This is a signal of an incoming recession. It is also possible that we stay inverted and we're still in recession. Generally, when we go into recession, this reinverts. So that means it goes over, well, you can't see it here. Let me go on the 5 year real quick. It goes over that black line. You see that black line? But if we look at the 70s and 80s inflationary recession, we can see that recession started even though that was inverted because the inflation was out of control. If the inflation is out of control, like we can stay in this environment for longer and be okay. And why can we be okay? Because there's more money to burn. There's more money in the system. So, but I did want to point out, look at the trajectory here. The trajectory from the end of July till right now has been straight vertical. Look at that. Anyone know why that is? Anyone at all know why that is? I find that extremely intriguing because something similar happened right here. And this is when we had those bank run bailouts. So what is this an indicator of? That skyrocketing vertical trajectory. And again, that's shooting up towards reinversion, generally after reinversion, recession. So that's shooting up. I wish I knew a little bit more why. Maybe someone can break that down, but that is shooting up. Keep your eyes on that. Now take a look at the 5 year break even. Here's what doesn't make sense to me. Okay. I'm not saying it's unhinged, but the 5 year break even is going up, not down, which is a sign that the inflation expectations is it's not unhinged, but it can certainly get unhinged. And this is exactly what the Fed doesn't want. That's going to create pandemonium, panic, and all kinds of stuff. But it's been going up. I don't understand that. Like, so on one hand, right, the headline is inflation battle, unless we look at the real numbers like core and things like that. And we can say, oh, well, actually inflation is horrible. But all of these headlines is the inflation battle we're winning, the inflation battle we're winning. But yet the market is saying you ain't winning nothing. You ain't winning nothing. According to this 5 year expectation, we're still at, look at 2.29%. This needs to generally be like 2% or maybe slightly under 2%. That's a big deal, you guys. Very big deal. It's like a double-edged sword. It's just really, really crazy. I guess that's what happens when you manipulate information, huh? You know, if people weren't manipulating the information, we have, you know, such such swings in information. Now, I wanted to point this out, guys, because we have finally hit over $1 trillion. They created a brand new chart. They had to, because the old chart only went to $1 trillion. This is consumer credit card debt. The last video I showed you, we were off the chart. But again, you guys can see here, they updated the chart. They added another 100 billion. So as long as we don't go into another 100 billion in credit card debt, this chart should be good. But anyways, guys, what a milestone. We have hit, as of August 4th, 4 days ago, we surpassed $1 trillion for the first time in history for consumer credit card debt. So, in other words, I kind of think that, you know, I think there's some problems out there in the economy. I think more time needs to go on for most people to realize that. I don't know why some people say what they do. I don't know. I guess I'm just a bear. But I'm a grizzly bear at least, right? When I hear the word bear, it's just like, oh, bear, weak. But really, I mean, come on, we're just talking about cautious. All right, let me pull some comments up real quick. Here's a comment from Susie. She says she paid 3 collections and 2 charge-offs, and it bumped her credit score 70 points. So that's really a statistic impossibility, depending on how they report it on your credit report. So there's 2 reasons, Susie, that your credit will go up if you pay off collections. The first reason would be if they're still reporting a collection as a revolving account. Because remember, with revolving accounts, when you pay it down, the utilization ratio drops and it gives you a score increase. One of the dirty tricks, listen to me, one of the dirty tricks collection companies do sometimes is they categorize collections accounts as revolving debt because they know it jacks you and your credit score up really bad. So either that's one of the reasons it was reported as a revolving instead of a collection, and or they gave you an off deletion letters, because again, paying off collections alone generally does not help your credit at all. And in fact, I've seen this happen multiple times. It can actually harm your credit. So there's something else in the puzzle that we don't know. And honestly, if you gave me your before and after credit report, I could tell you exactly what it is. I love credit reports. We have a comment from AJ. AJ, appreciate you, man. My government loans, I'm paying off, and I should have them paid off by the beginning of next year at the latest. I mean, look, the reason I brought this up, I mean, look at this man. I mean, props to you, AJ. He's paying his school loans off, and he's proud of himself, as he should be. He's not asking for something for free. This man is sacrificing and staying disciplined to get ahead in life. And AJ, I just wanted to say, man, props to you. And you should be absolutely proud of yourself, because a lot of society does not do that. Props to you, brother. And I appreciate all your emails, by the way. Here's something from Ima. Long story, not my birthday. Oh, it's not Ima's birthday. Ima, we thought it was your birthday. Now I'm reading that comment. All right, here's one. Another comment here from Don't Move. I'm so sick of people comparing high rates to the 80s and the rates that were in the teens. Investment returns when in the teens also then, and that's not the case now, no correlation. And then also what's no correlation is home value. I mean, people are talking about, oh yeah, in my day, interest rates were double, and I get it. And like, yeah, in a normal economy, we can handle those double interest rates, right? But it's really hard for me to take people like that seriously, because they leave part of the equation out, which was median sales price was what, a little over $100,000. So like, I understand the point though. I mean, it was higher rates back then. All right, dental coverage. Always appreciate you. Are you a dentist? Let me know if you're a dentist, man. I always wondered that. I appreciate your comments. I appreciate you empowering yourself. Up, down, up, down. Do you guys remember that code? Up, down, left, right, up, C, down, C, left, C, right, C. Sonic the Hedgehog. Do y'all remember Sonic the Hedgehog? And that up, C, down, C, left, C, right, C, A, start. And then you got, anyways. Man, I can't believe I remember that. What was this? Then the Black Swan dump coming, peeps. Yeah, so that's the thing. That's what I'm also trying to say. It's just like, I tell people right now, as far as like recession, a catalyst is time. A catalyst is time. Literally, the economy is barely hanging on right now. It's being propped up, and all this money is still in the system propping it up. The moment another Black Swan event comes, I mean, it's going to be total chaos. It'll be total chaos, because even if they bail them out, and print money again, what happens to inflation? Inflation starts getting out of control. We can already see in the 5-year break even that interest rates are not high enough. I said it. Interest rates are not high enough. We can see it. I'm going to say it again. Interest rates are not high enough. Do you guys remember the Sonic the Hedgehog thing? Mr. Watson, how are you, brother? So I just wanted to say, man, welcome back. I hope that you enjoy the show. I don't think that you're being a hypersensitive realtor and hater. I was called that last time I commented on your live streams. Well, this time I'm going to say, Mr. Watson, thank you for being here, brother. I hope you have a great day. And I appreciate your commentary and opinions. So please continue to share them. This guy right here, you know I'm going to talk about you straight. So Straight Drive, I'll have to throw you under the bus real quick. Now, Straight Drive, I'm trying to befriend him. This guy right here is like the ultimate troll for crash videos, right? I see him all over, like on Reventure or Michael's. So anyway, so one day I just reached out to him. I'm like, hey man, what's your points? But I wanted to tell you, this guy, he's actually super funny. He has some really good points, but if you're a content creator, you see this guy, don't take it seriously. He has like 5 troll accounts and he talks to himself. He's trolling from 5 different, so he's having conversations straight. Stop doing that, man. You're so funny. If you just spent that much time listening to what I was saying and researching, I think you're going to be better. But man, I just wanted to say I caught you, and it is hilarious. It is hilarious. I caught him the other day. He forgot to log out of his account. House Hacker 69. So he actually purchased in San Diego, and this is someone that I really respect because he was able to purchase a house in one of the most unaffordable places in the U.S. with almost no inventory. And he basically, his point is, let me pull up this comment right here. Basically, his point is what he's trying to tell people is like, you can find a great deal in any market, right? Which is basically true. If you can find a great deal right now, you should get it. The point I'm trying to make is there's almost no great deals, and most of the people that are purchasing don't even know what a great deal looks like. They don't even know that you should look for a great deal. They just think, oh, primary house, check, moving on with life. That's literally how people buy houses. Oh, I'm an adult. I got to go buy a house. Let's just go buy one. I'm telling you, it's insane. It's huge. Okay, let's see here. So, hey, appreciate the super chat. Let me go back to live real quick, guys. All right, so living in Omaha, appreciate you, man. Let's see here. Question, can you break down and explain the 2 and the 10-year yield inversion? I've never understood that. So going back to the yield inversion, there's a few reasons, and basically the problem is, and I have a video already on this, living in Omaha. I think it's about 5 videos deep. It was a live that I did, but I tried to go in and explain, like, there's first of all, there's multiple reasons why the yield curve inverts and why it's a problem. One of the reasons is basically a flight to safety. So it's one of the reasons is a lot of people are basically pulled their money out of various investments like the stock market, real estate investment trust. Maybe they sold real estate, whatever, and they started purchasing treasuries, or they flew to a safe investment. Another problem with the inversions like that is lenders and financial institutions make way less profit. Because remember, lenders lend basically on the short, long term, but they borrow on the short. I'm sorry. It's a long-term versus short-term thing. So in other words, what I'm trying to say, it's super confusing. I'll pull up and do another episode where I have a lot more equipment and gear in front of me. But in other words, the lenders make a lot less money. So a lot of issues there. And the reason why also that this is an economic indicator is because generally when this happens, it does lead to recession. It's basically a warning sign from people, in the US and banks and whatever, that there is pain coming and there's cause to be concerned. So that's a lot of where the money is going. Anyways, I'll do a better explanation of that. I don't have it up in front of me, but I did do a breakdown of that. Let me see if there's anything else we got to cover. Let me look at the 10-year real quick, guys. See what we're at with the 10-year and see what we're at with the VIX. Oh my gosh, I just looked at the VIX. This is wild. I'm going to just show you guys real quick where we're at with that. The VIX is even worse. Look at this. The VIX is at 12.87%. So the market is not happy right now. With something, not happy at all. Let's go into the market. I mean, look at this. It's pretty crazy. Probably has a lot to do again with the with China and all that numbers reporting. Anyways, you guys, definitely appreciate you being here. Don't want to keep rambling. I appreciate each and every one of you. You guys have a great day today. And do not forget, please make goals, and your goals are going to shape your approach. Understand what it is you want in the housing market. Like, for example, I know what I want. I want to find my dream home at a 2019 price. And I'm willing to wait for that, right? And I'm also hunting every single day in my market. I'm building my credit, my income, and my assets. So every day I'm on the sideline. Not only am I looking to purchase, I'm also increasing my purchasing power. Let's not forget that. We don't want to be blindsided. In other words, we also don't want to miss out on future opportunity. The more we're disciplined right now, the more we increase our purchasing power right now and have more money saved right now, the higher probability that we will become winners on the other side of this thing, regardless of where we end. Remember that. People are suffering. You don't have to be. So stay encouraged. Do not give up hope no matter what. All right. And I'm not talking about false hope. I'm talking about keep your hope because you're working hard and you're sacrificing, and you should be empowered by your own self-sacrificing. And other than that, guys, if you're out there investing in real estate, you know I wish you luck, and I hope you win.